Thank you, and a very, very good afternoon to everyone. Um, and thanks a lot to to all the panelists here for for joining this invigorating session. AIF3 as an asset class definitely cannot really be ignored. Just a little bit about what AIF3s really are. SEBI has come out with SEBI has created this new asset class, which is colloquially what we call like a hedge fund class, but it's really something much more than a hedge fund class. AIF3s deploy complex strategies. They leverage. They can invest in listed, unlisted. They can hedge their risk, and they've, over the last few years and also coming in the future, they facilitated in creating an all-weather portfolio by optimizing superior risk-adjusted returns. What we have seen is that, long funds have found a lot of favor with this asset class. When we talk about how this asset class is, this category is poised to grow in the future, we are talking about almost 2.5 lakh crore growing in the investment side over the next 2 to 3 years, with almost 60,000 crore being committed by top players in the industry. Of course, we've seen that the kind of investor base that this asset class has attracted is more on the HNI side and the ultra net worth class, specifically, looking at restrictions for institutional investors to invest into this, but we'll talk about that a little bit more. So what we're really going to be talking about in this panel is, we're going to be talking about experience that everyone has had in dealing with this asset class. We're going to be talking about what are the strategies which have worked thus far, what are the new strategies which can be adopted, how this asset class is evolving, what are the new product offerings. We're also going to talk a lot about regulatory challenges, operational and compliance challenges, and of course the future of this asset class, even when we compare it to mutual funds. So without much delay, let's just jump right in. Let's talk a little bit about investment strategies, and Bhautik, I'm going to just turn to you. We've seen that long-only funds have found a lot of favor with this asset class. We've seen almost 61% being deployed towards long-only funds. Of course, long-short funds are there. They've not been immensely or hugely popular. We've seen arbitrage and credit funds, but what really is your take on that, and why has this class been more successful than the others, and what is your future outlook on this?
Thanks Parul. So I'll just take a step back there, and so one of the things that Cat3 funds offers, which a lot of other category of products, so let's say a PMS or a mutual fund cannot offer, is superior risk-adjusted returns, because no other asset class in India today gives you the flexibility of generating better returns with the amount of risk that you take. What do I mean by that? If one has to generate superior risk-adjusted returns, then you need to have the ability to take positions on both sides of the market. If you can't, then you are going to get impacted with market movements. And that's exactly one of the challenges that a lot of other categories face, but that is a solution that a Cat3 fund can provide. And that's exactly the reason why you've seen a plethora of long-short funds being launched in India. And again, long-short is a very broad term. And within long-short, you have funds which get launched in conservative category. You could have funds which are more aggressive. You can have funds which are, giving solutions to something in the middle. So a bunch of different products which can be offered within the long-short space as well, in terms of what can be done on or in terms of Cat3. So I think what Cat3 does is that it can provide solutions to things which other platforms cannot provide, which is something that a lot of long-short funds have done. Like, for example, in our case as well, what we have is we have funds which give solutions as a debt replacement, as a conservative long-short funds. We have funds which can offer as a replacement to equity funds, which is more on the aggressive side, which again is giving you superior risk-adjusted returns by using a combination of long-only and long-short. So these are some of the things that can be done as unique offerings or as solutions which a lot of other category of products cannot offer. So that's one of the things that has happened. What we've also seen in the last few years is a lot of people are also using this category to launch products in other asset classes. So for example, people are trying to launch products within fixed income, people launching products, using a combination of fixed income, commodities and equities. A lot of these combinations are possible, or solutions are possible, which again, some of the other categories of AIFs or PMS or mutual funds cannot offer as a solution. So that's something which is happening in the Cat 3 space. So I think, yeah, we'll talk about more about international funds, but I think at least in India, that's what we've seen so far.
Yeah, thanks. I'm going to, just turn to Mr. Madan Gopal. On the investment strategy part, and I think we were just talking before this panel, what has your experience been on, the investment strategies which have been deployed and which can really be deployed for Cat 3 AIs?
Yeah, so our AIF investments have been mostly long only, and we have not gone into long short. Basically, we felt that we have been here in the alternate space through our PMS products for almost now 15 years. So there are distinct value zones that we find in the market, and we evolved these PMS strategies towards those value zones. So we launched AIFs also under the same value zone sort of a perspective. So what we did is, if you observe, there are two ways in which a large value zone gets created in equity. One is structural growth, which is an outcome of after a company comes into market, probably a PE exit. That's something in sectors like consumer discretionary, in fintechs, in all these areas we find that growth still extends for another 5-6 years. You can invest into them. But other area is cyclical. If you look at mid and small caps in India, they go through a very large extension of premium compared to Nifty, almost like 30% premium in a peak to almost like negative 10% in the down cycle. So somewhere during, just before COVID, if we look at mid caps hit that negative zone, and then I'm not even talking about the COVID period, just before COVID they hit a negative zone compared to Nifty. So we used AIF platform to launch mid cap products, and they have done a reasonably well, and the market definitely, given the flows in the mid cap space, also helped. But one way of launching some of this long only is look at this kind of cyclicals, and thematic is another zone, but broadly we have restricted to these two value zones. One is long only, investing into structural ideas, another is the cyclical, which is more of investing into mid and small caps, but that is mostly cyclical and close-ended sort of products. In the long only, we have open-ended products, and we see ourselves as an extension of private equity. Most of our investments in that space is in consumer discretionary, NBFCs, fintechs, e-commerce, and then manufacturing or energy transition, we would say. So this is how we have structured our products. Most of them have given a decent high teens to high teens sort of returns in the last 5 years.
So that's also, focusing a lot on the long only strategy. But Bhavdi, when we talk about debt, I mean, we are talking a lot about long only strategies, and most of them, these funds have been around either derivatives or, what about debt funds? Is there a market for Cat 3 debt funds? We've seen Category 2 debt funds, but of course those are close-ended. How do you see the outlook for Category 3 debt funds evolving?
Sure, Parul. So thanks for that question. In fact, what we have seen in AIF industry, I think over the last 10 years, we have seen a phenomenal growth. I'm coming from the funds industry, and mutual fund industry took 30 years to reach 10 lakh crore. AIF industry has done that in 10 lakh crore, so in just about 10 years time. So I think that's a phenomenal growth that we have seen across AIF categories. Within that, if we look at that Category 3 has a very distinct feature which are not there in Category 1 and 2, is the liquidity part. And oftentimes we forget, maybe once in an entire cycle we realize what is the premium and what is the value of that liquidity. But that's what is available in Category 3, and to that extent I think we have seen a phenomenal growth in Category 3 as well, I would say. I mean, of course we want more of it, but let's not forget that in Category 3 typically AUM is equal to, the commitment is equal to drawdown, right? Most of the time, very, very close numbers, whereas in case of the rest of the industry it's not the case. Coming to fixed income, I think if you look at the Category 3 as a product, as a product structure, we have seen more of equity dominance there, and we have not seen more of fixed income propositions on that side. But if you look at the investor segment within in category 3, it's dominated by HNIs and family offices, and they too have a need for a higher risk adjusted return along with liquidity. And I believe that there is a huge potential, untapped potential in launching fixed income solutions within category 3 AIFs. We have we have been running one fund for the last 6 years now with 9.5% plus post expense return, and it's a fund where you get a monthly liquidity. Now, it's just a case in point I am highlighting. I think we need many more such funds in the category, so that there is greater awareness and greater kind of communication and interest amongst investors. So I believe both the investor side there is a need for it, and also investing company side there is a need for 6 months, 12 month, 18-month papers, right, or the fund requirements. So I think there is a decent market both on the demand and supply side. All that is required is to kind of create a product structure which can really breach this demand and supply of short-term debt. And to my mind, that is one area, fixed income in category 3 is very clearly has a huge potential and is so far untapped. And I believe that more and more interest will come up over time. In fact, over the last 5-6 years, even equity in general, whether it's mutual fund industry or AIF industry, had kind of seen the exuberance that is very difficult to see, or we have never seen before in our Indian context as well for sustained period of 5-6 years. Maybe that is the reason why fixed income was a forgotten asset class in general, right? So, but good to know that at AIF industry level, just one last number I wanted to give before I hand it over back to Parul, is that we don't realize, or how many of you have noticed it, but in last 5 years, the private credit as a percentage of AIF commitment has grown from 5% to 16%, right? So there is a phenomenal interest and growth in private debt in general, private credit in general, but more of that growth is concentrated in category 2 products. I believe that category 3 too has a good potential to kind of create this bridge between demand and supply of such short-term debt.
Add one more thing to what Navdeep mentioned, which is around type of investor. So far what we've seen is all the interest in Cat 3 has come in obviously from high net worth individuals, family offices, to a certain extent corporates. But now where we are seeing some amount of demand is with this accredited investor regime that has come out from SEBI. I think there is a way that you can fractionalize some of these investments and you can get participation from a much wider base of investors to participate in AIFs, including Cat 3. So I think that is something that we are seeing. There is some amount of demand there. I think there is a long way to go because there are only a handful of accredited investors in India today. But I believe, at least at this point of time, there are few people who are trying to take a lead there and trying to get many more investors accredited, and who can then access many more AIFs, many more PMSs, taking that accredited status.
So actually, that's a good segue into the next discussion point, which is that, and you hit it right on the head, that the investor base primarily consists of HNIs and ultra, HNIs. We've seen that, insurance companies, retirement funds, other institutional LPs, they're not really permitted to invest into a category 3. There was a discussion that happened around it yesterday also. It was a very interesting session. Insurance companies are at least permitted to invest to a certain percentage in category 1, 2, and they have been doing that. Isn't this asset class actually a little bit more geared towards their objectives because it's more liquid? You can do a mark to market, you can figure out when to exit, you can tie in your returns, it's a superior risk adjusted return. So what is it that we're missing? And how do you really increase the base? Because from what all that we've been talking about, it seems to be a far superior asset class even as compared to a 1 and 2 where, it's highly illiquid, and looking at the performance of the way at least India is booming, so what is it that we are missing here?
So I'll try and answer that to a certain extent. So I think what is missing is intent. Which is clearly something, which needs to move in this direction, because as you rightly pointed out, Parul, this is an asset class which compared to a lot of other products gives them liquidity, superior risk-adjusted returns. It gives them a potential to access categories of products which they can't access using other products or other platforms. I think it's the intent to understand what can be offered here. If you go globally and look at most other asset managers who operate globally, bulk of the assets that they get is from institutional clients. which is completely missing for Cat 3 in India today. And if that segment today, whether it's insurance companies, whether it's retirement funds, can start accessing Cat 3 funds, I think both sides will benefit in a large way. But like I said, it's the intent which is a challenge here. There are a lot of solutions which can be created in Cat 3, which can't be created elsewhere. A lot of these funds do need the liquidity, do need some amount of this flexibility, which again a Cat 3 fund can provide because of the nature that it's open-ended. There is flexibility available out here. There's liquidity available on a regular basis. But that's something that is missing. We are trying to work as a council, to work with some of these institutions to try and see if we can get some of them to start looking at Cat 3 funds. But I think it's still a long way to go before we get there.
Yeah, just to add to what Baudik mentioned, I think typically what you see is that most of the institutions, whether it's pension fund or insurance companies, they have the horizon benefit, right? I mean, they don't need as much liquidity. But to my mind, one class of investor which can definitely kind of start participating more aggressively or judiciously is treasury, corporate treasuries, because they appreciate liquidity a lot more, right? The kind of premium or value they put on liquidity is much higher. So to my mind, besides HNIs and family offices, I think treasury, corporate treasuries is another segment of investors which can really find value, whether it's fixed income or some of the strategies that my friend runs. Those kind of solutions can make more sense to corporate treasuries as a new customer segment for the category.
Yeah, and just to put some numbers in perspective, I was reading somewhere that $121 billion is what insurance companies have. I think that's an IVC report itself. And about $38 to $40 billion is what pension funds have. I mean, look at the size. And if they were really permitted to invest, probably this industry would grow to 3x to what it is right now. And probably we would have a special IVC, a Cat 3,
And the point is that they just don't benefit from a return perspective. It's also a perspective that it helps them protect against downturns as well, right? Which is something that you need from long-term perspective,
Absolutely,
right?
yeah. And probably that's the reason globally, we see more of pension funds investing in hedge funds, etc., as compared to India. So, Udit, we've been talking a lot about, new products, etc., but purely from an operational perspective, what challenges do you really see in, in operations and setting up, and where are we on the digital transformation? Whether we're talking about onboarding of investors, we're talking about, this whole thing about demat accounts. How is technology playing its role here?
Hi. So basically, any framework that you would follow, right, in terms of how do you deploy technology or what should be a prioritization, it's effectively regulatory, risk, and then it comes to operations and marketing. So from a regulatory perspective, the reporting requirements that are there, which means that your fund accounting partner, or even if you're doing it in-house, the solution needs to have enough checks and balances so that you can be comprehensive and in time, because there are deadlines, of course. And it also gives you an opportunity to, kind of address risk in some manner as well. So, let's say if you're doing redemptions now, if you don't have solid internal checks in place, let's say if your custody systems and the fund accounting systems are not talking to each other, you may end up, having errors. You could do the same redemption twice, very common, right? So, or very commonly possible, may not be as common because there are certain checks in place, but these things can be easily addressed. Timelines can be improved, the operational leverage can kick in for both the fund managers and the service providers with the use of technology. And then, as you come into, marketing, your fact sheets are getting generated through tech platforms. Digital onboarding obviously is a very large piece of it, which helps, in reducing the friction when you're onboarding investors. And you obviously, that's the beginning of the journey post the sales is done. So, part of the investor's interaction with the fund starts with the onboarding process, right? So, if there's a lot of back and forth, it creates issues. So, that part can and is being handled to a large extent now. But, obviously there are improvements that can happen, which we've been working towards. And then, your daily operations, kind of also can become much smoother and a lot more risk-free with the advantage of technology. And I think that's slowly coming in. it's easier for, nimble players to do it. Obviously, larger organizations will have their own challenges while they can invest more. So on the fund house side, we are seeing a lot more adoption. On the service provider side, obviously, it's slightly slower, but eventually, hopefully, it catches up.
Anything on the regulatory part, we're seeing, foreign investment coming into AI3s, of course, one needs to be mindful of the limits. Any FPI that's investing into a category 3, the category 3 automatically can only invest in securities in which an FPI invests. We also have the PN3 restrictions for money coming in from neighboring countries, and there was a, the manager needs to do due diligence to figure out the beneficial ownership, and there are limits and all which have been put forth. So how does that shape into the whole compliance part, and what do you really need to keep in mind to make sure you're adhering to these regulations?
See, I mean, anywhere where there is interaction of more than one regulator does make it slightly more complicated than having to deal with only one regulatory framework. Here, because effectively FEMA and SEBI regulations coincide, there are certain aspects which are not very clear, where more clarity would be welcome and would make life easier for banks also and for fund managers both. So for example, let's say whether NRIs are covered under PN3 at all or not, whether AIFs themselves are covered under PN3 at all or not, and this leads to implementation of the regulatory framework differently across different counterparties. So certain banks will have one way of approaching it, the others may have a different approach, which leads to information arbitrage, regulatory arbitrage, and general confusion. So while SEBI has come out with a more detailed explanation of what needs to be done when foreign money comes into it and what is from a PN3 perspective, but the same synchronicity is not there with the RBI. So let's say maybe some kind of a combined panel, given the fact that it impacts everybody. It's not just a Cat 3 problem, whether you are taking foreign money, and any foreign money, it's not just an FPI entity investing, but any foreign money through the direct route coming in also will need, let's say, INVI filings, it needs your reporting, etc. to be done, your compliances to be taken care of. So it can become much easier, and I think maybe the industry forums that are set up are also specific to the industry. So there is an AI forum, but they would also find it difficult to get explanations promptly from RBI. So some kind of a cell which takes care of both other points where there is a confluence of both regulatory frameworks would be very welcome, and would provide a lot of clarity.
Yeah.
I just want to add to what you just mentioned. So I think one thing which Cat 3 misses today to a large extent is standardization. When I say standardization, that's across the board. So for example, when you see mutual funds, the reason it's scaled up well, and a lot of things are pretty smooth there, and it's been scaling up month on month, year after year to a large extent with the number of investors as well, is because most of the things are standardized. And when I say standardized, it's not only operations, it's onboarding, operations, it's compliance, it's how you interpret a lot of these regulations. All of that is fairly clear and fairly transparent, which is something which is missing at this point of time to a large extent with respect to Cat 3. So for example, when I look at onboarding, yes, we've moved the digital way, but if you ask any service provider today, what percentage of clients have got onboarded using digital versus physical, you still see that percentage as very, very low, right? It's not that clients don't want to get onboarded digitally, it's just that that process is not standard and hence creating some of these challenges, right? Similarly, if you see even in terms of fund accounting, if you see in terms of how funds kind of and apply tax on their funds, how they interpret some of these tax rules, is left to managers to do it their own way, or to some of these service providers, rather than they're having a standard approach, which not only creates challenges for fund managers, but it also creates challenges to a certain extent for investors over a period of time.
Tax has anyway been a very sticky issue where Cat 3 has been concerned. I think that's no longer an ask, it's just an accepted, that there is going to be confusion where tax, and we'll talk about how the GIFT City helps this. But Mr. Madan Gopal, I mean, any comments on, how, SEBI's now also brought out a consultation paper, how a new asset class can be, brought about under for mutual funds for a long only. Of course, it's all very speculative because the circular is not out, it's just a consultation paper. But how do you really see the AIF category 3 shaping up when compared to, we have mutual funds, we have the PMS scheme, and how does this, where really is the future of this industry given, where we are headed? And also, keeping in mind, Bhautik talked about how there is lack of standardization, but for mutual funds, there is a fair degree of standardization. So how does it all stack up, and what is your key ask?
Yeah, I think definitely taxation is a big advantage which the new structure is offering to the investors. But we have to keep in mind that this product is very different from a risk return perspective compared to mutual fund sort of a product. A mutual fund is more like for retail oriented investors investing into almost 50, 60 stocks, sort of diversified funds. We are talking here about investing into 15, 20 stocks. Look, if we look at our products, we invest not more than 20 stocks at any point of time. And the way the returns behaves here is not going to be in sync with the benchmark all the time. There could be even 6 months to 1 year of period where we will behave very different from the benchmarks, because we invest with a 2 to 3 year perspective. So such kind of differentiated products for retail investors has to be really looked through into with the prism of what risk we are taking. There are advantages, as you said, on the tax side, but there are also advantages of being out of a lot of regulation that is there, risk sort of processes which are there, looking at the benchmark, which might make this alternate space more like a mutual fund as we get into the ambit of mutual funds, in my opinion. Being away and thinking very different from the mutual fund, thinking very away from the benchmark is the prima facie very important stuff in the alternates. So to that extent, if we can create the returns, I think we are talking about, in our experience in the last 15 years, taxation impact is almost like 1.5% on a CAGR basis, which is not a very difficult task to be crossed over for an alternate investments. So we don't think this is a challenge, but always it is important to, even if it is launched under the mutual fund for the tax advantage, maintaining the risk return perspective as it is for the alternates. That's going to get challenged at some point of time, which we feel that's a very important aspect that needs to be maintained.
Right. So if we talk about, since we're talking about tax now and standardization, and, we have a new framework which has been come under the GIFT City. Of course, under the GIFT City framework, Indians cannot invest in a GIFT City which is coming back into India, but they can invest outside India. GIFT City also has a special framework for category 3 funds, where if it's a specified fund, which basically means only non-resident money primarily, then there are certain tax exemptions which are available. Basically, it's been kept at par with, let's say, a Mauritius fund or a Singapore fund. But I understand that you're not happy with that.
Of course, there are a lot of great things which have happened, and some of these issues, which are there as part of the domestic structure, do get addressed in the IFSC structure to a great deal. It's more, let's say, maybe in terms of outbound funds where there are still some gaps. And of course, it's an evolving jurisdiction. There will be gaps which will be there, which will get addressed. And there's going to be a country-specific solution for us. Like GIFT City is very different from jurisdictions like Mauritius, Singapore, which don't have a large hinterland, right? So maybe Hong Kong to some extent, but again, it's a very different setup there. So GIFT City has its own advantages, and there may be certain tools which may not be available, which are available at a global level, but things that can be fixed maybe is, let's say, on the outbound side where the taxation is, as whenever alienation or let's say a churn happens at the fund level, which essentially results in GIFT City today for outbound structures being used more as a feeder rather than the master. Now, if we can solve for that and ensure that taxation for the investor, which is going to be the Indian investor, domestic investor, it happens when there is redemption at the fund level, that can go a long way in bringing that parity. Because if you as a resident investor, if you invest in a Mauritius fund or a Singapore fund, there the taxation happens when you redeem, not when the fund is churning. So from a compounding of returns perspective, it makes a big difference to the investors.
Right.
Just on GIFT City, I think, even though the regulations are relatively new, it's just been like around 3 years since the time the regulations come in. I think they've come in very, very long way in terms of creating this entire ecosystem and the framework for funds to be domiciled out there, whether it's for money coming in or let's say, some funds want you to take money out and investing in global strategies. So I think that ecosystem has come a long way. Obviously there is more to do, there is always more to do. But I think the pace at which things have moved, they've been phenomenal. We've not seen something like this in the past with any other regulator. I think what it does offer is, it does offer a lot of investors or a lot of fund houses to offer solutions which are very unique. So for example, one of the things that we have recently done is, set up a fund which is going to be giving access to not only resident Indians but global investors to be accessing strategies to generate absolute returns in the global markets and not just India markets, right? Which again is very, very difficult to get, very difficult to achieve by investors just investing in India, because then you don't have the flexibility, you don't have you don't have the solutions which are available where you can invest in multiple asset classes, you can't invest in multiple countries or multiple instruments for that matter. And that's a solution that one can offer by accessing funds globally. And that's something that a lot of investors are looking for, at least when we are meeting them, talking to them right now. These are solutions that they're definitely wanting. And if somebody is ready to offer them, then they are looking at investing in some of these solutions.
Yeah.
Just one point I wanted to sort of add here is that in GIFT City, I would say what AIF is to mutual fund is what GIFT City is to AIF in terms of the product possibilities and the innovations. For example, leverage otherwise is not available, right? Leverage based product to kind of offer under SEBI regulations, even under AIF. Particularly on the fixed income side, for example, if someone wanted to borrow and invest, that's not possible. Recently, we have launched one fund in very interesting structure that 2/3 is the loan component and 1/3 is the unit component. All of the entire corpus will go into the fixed income, climate focused fixed income investments. So to that extent, I think there are lots of possibilities, and as Bhautik rightly mentioned, I think over the last few years, 3 years or so, I think the regulations or the entire ecosystem has kind of come up quite well. Today only we were with GIFT City chairman, and he was mentioning that there are more than 240 AMCs which have already got registered there, and there is a decent amount of acceptance from global investors, including institutional investors, for the GIFT City platform. So I think the entire ecosystem is coming out very nicely, including the fund administrator and the related service providers. So yeah, I think the prospects in the GIFT City are pretty good, except that in category 3, for example, particularly the fixed income as a product category that our franchise kind of offers, there are limited possibilities on that side, because there are certain FPI regulations which prohibit investment in less than 1 year instruments. And because these are liquid investments, you can't really go for very, very long period of, longer dated papers also. So I would say that particularly for Cat 2, Cat 1 and Cat 2, there are humongous possibilities, in terms of product innovations as well, through GIFT City product platform.
And I think I would add to that and say that, it can't really be a replacement to Cat 3 even for outbound, because the investment that's permitted on a per year basis, that's just limited to $250,000 a year. That's really little. You cannot really grow and you cannot scale up with that. Institutional LPs are anyway not permitted to invest outside India. If you have unlisted companies, family offices, then again there are a number of restrictions. So it seems to be a very restricted way, while IFSCA has done well, and around the FPI regulations as well, 100% investment by NRIs is permitted as compared to 50% in other offshore funds, but probably it still needs a little bit more change around the capital account convertibility and repatriation for this to work. So I think I'll just go around this panel since we have 2 minutes, Bhautik, starting with you, and how do you really see this? What is your thinking about the future of this industry in the next 3 to 5 years, and where do you see this going in terms of new products, new offerings, and do you really see the season changing from long only to Bhavdeep is saying it's going to be credit, debt, how do you see this changing?
My thing is very clear. I think globally hedge funds is what Cat 3 is trying to solve for in India. And hedge funds anywhere around the world, you can look at different percentages, but it's broadly around 10 to 15% of investment allocation from large investors happens to hedge funds. In terms of amount, that will be running into trillions of dollars. And that's something which is what we can solve for, and which is something which is missing in India at this point of time. Even though we do have a handful of long-short funds, but the AUMs that we manage is very, very small. So this can become a much larger category going forward. Obviously, there are a lot of asks from the industry, which we've been placing with different regulators and different authorities within the government for the last decade or so. Some have happened. A lot of things need to happen for us to get anywhere close to what is offered globally, and if we have to scale this industry to a larger scale. But because if that doesn't happen, then that 15% of the pie that is available globally, which people invest in a certain category of products, will fail to exist in India.
Yeah, so from my side, I would suggest that investors relook at their asset allocation. In fact, with whatever has been happening on equity side, fixed income is coming back into conversations now. I keep hearing that most of the advisors had been kind of pushing for more balanced mix of asset allocation over the last 2-3 years, but investors were just in a different mood altogether, and a significant portion of incremental allocation was going into equity. I think fixed income is coming back at least in conversation right now, because investors need that income orientation and stability in the portfolio. Otherwise, it's like a carpenter using only hammer, for all the solutions. It just doesn't work, right? You need every asset class has its own role to play in investors' portfolio. And I think fixed income as a tool needs to be there in everyone's toolkit, whether it's an advisor, distributor, investors, family offices, etc. And to my mind, AIF has a huge potential to serve that need, and that is the superior return with higher liquidity. Right, so this combination is really rare, and this is something which, with whatever little experience in 6 years of track record as an industry and us as a franchise, we have been able to demonstrate. And I think there is a huge potential with new manufacturers kind of coming in and more investors embracing this product category. So yeah, that's what I would suggest.
Within equities, I think last 3 years have been very good for passives and diversified funds, because the overall index itself did well. But next 3 years, I think it's a fantastic period for long only focused or concentrated sort of funds, which are in the AIF side. Given that market is likely to be volatile, the tail risk will come into the mutual funds and passive funds, which will reduce the overall risk potential for these categories. In these periods, in the history also, focused funds with long only sort of an approach, growth oriented approach, has done really well and created meaningful alpha. I think that phase is coming now. Over the next 3 years, when we see that the equity returns in the index is going to be probably in the single digits in our opinion. So it will be a fantastic period for for the long only focused funds, if they get the sectoral calls right, a period where they can create a meaningful alpha over the other equity products.
See, Cat 3 funds basically have the biggest arsenal that's out there. Out of any pooling vehicle or a non-pooling investment vehicle that is there in India, as in terms of the kind of structures that can be done, kind of asset classes that you can invest in. So it is, there are restrictions as we discussed in terms of what kind of investors can come in. Also in terms of taxation, calculation of the leverage ratio, the leverage itself. So some of these things hopefully get addressed over time. And this category has actually the biggest potential. Quant, for example, is one large piece which is kind of coming into India right now, still on the fundamental, quantamental side, but those strategies are the ones that actually afford the best risk-adjusted returns in a very objective sense of managing the strategy. So, this category caters to all of this. And with certain amendments, certain reforms, I think this is the way forward.
So diversification of strategy, broadening of investor base, regulatory certainty, and tax clarity. That sums it all. Thank you so much. Thanks everyone for joining us for this panel. Thank you.